What if I told you that the biggest financial disaster of the 21st century started with something as ordinary as a home loan? Not a cyber attack, not a global pandemic, not some secret government experiment, just houses. And within a few years, this safe investment wiped out trillions of dollars, destroyed millions of jobs, and collapsed some of the most powerful banks in the world. This is the story of the 2008 financial crisis. The beginning, the safe bet. In the early 2000s, the tech bubble had just burst. Investors were nervous. They wanted something stable, something predictable. They turned to housing. For decades, home loans, mortgages, were considered safe investments. People usually pay their loans. And housing prices? They seemed to always rise. Banks saw an opportunity. Instead of keeping mortgages, banks bundled thousands of them together and sold them as investment products called Mortgage-Backed Securities, or MBS. Investors loved them. Steady returns, backed by real homes. But the system didn't stop there. Banks began creating even more complex products called Collateralized Debt Obligations, or CDOs. These mixed safe loans with risky loans, but labeled the entire package as low risk. How did they convince investors? Credit rating agencies gave these products high safety ratings, even though many contained dangerous loans. At the same time, demand for mortgages kept rising. To keep the machine running, lenders began approving loans for people with weak credit histories, known as subprime borrowers. Many of these borrowers couldn't realistically afford the homes, but banks didn't worry because they weren't keeping the loans. They were selling them. Risk was being passed around the financial system, packaged, repackaged, and sold again. Boom, the explosion. Credit default swaps, or CDS. Then came another layer of danger. Credit default swaps, or CDS. These were like insurance contracts. If borrowers defaulted, the seller of the CDS would compensate the investor. It looked like easy money. More mortgages meant more securities. More securities meant more insurance. More insurance meant more profit, until borrowers stopped paying. By late 2007, subprime borrowers began missing payments. Foreclosures surged. Houses flooded the market. And when supply increases too much, prices fall. Housing prices dropped sharply in 2008. Suddenly, those safe mortgage securities weren't safe anymore. They became toxic assets. Banks started reporting massive losses. Financial institutions stopped trusting each other. Lending froze. And then came the breaking point. On September 15, 2008, Lehman Brothers declared bankruptcy, the largest bankruptcy in U.S. history at the time. Panic spread across global markets. Stock markets crashed. Businesses couldn't access credit. Companies laid off workers. By 2009, the global economy had stalled. Millions of jobs were lost. The aftermath. Ironically, many financial institutions that played a major role in creating the crisis received massive government bailouts. To prevent a repeat disaster, the United States introduced the Dodd-Frank Act in 2010, aiming to increase regulation and oversight of financial institutions. But the deeper lesson wasn't just about housing. It was about hidden risk, overconfidence, lack of transparency, and a financial system built on trust that collapsed when that trust disappeared. Because when confidence in money disappears, the entire economy shakes. And that's how a simple mortgage contract triggered a global financial meltdown. But here's the real question. Could it happen again? Financial systems today are more regulated. Risk models are more advanced. Oversight is stronger. But human behavior, greed, overconfidence, herd mentality, those haven't changed. History doesn't repeat itself exactly, but it often rhymes. And understanding crises like 2008 isn't just about the past. It's about recognizing the warning signs of the future, because the next financial shock won't announce itself. It will look safe, logical, profitable, just like housing did. If you found this breakdown valuable, make sure you subscribe for more clear, no-nonsense explanations of economics, finance, and the hidden psychology behind global events. Like this video so it reaches more people, and comment below. Do you think another crisis like 2008 is possible in our lifetime? I'll see you in the next one.